Good evening. Welcome, everybody. Thank you for joining us here at the virtual FinTech Fair. We're going to be talking about the institutionalization of digital assets, which is a very hot topic. In fact, this is probably the most exciting panel in the entire 2 days. So if you've come to this panel, I'm sure this is probably the main reason why you've signed up for the whole event. So, not to disparage the other panels, I'm sure they're great, but this one is the best. So what are we talking about here? Why is it so exciting? And who am I? I'm James DiBiasio. I am founder and editor of DigFin, which is a media business. It covers digital finance, and you can find me at digfingroup.com. The content is free, and it's there for you to learn from. I've got a great panel, but let me first just sort of set the stage, and then we're going to go into the meat of this evening's discussion. And also, throughout this period, you've got a Q&A tab at the bottom of your Zoom panel. We're open to questions, so feel free at any point to shoot one over, and we'll try to address them towards the end of the session. So, institutionalizing digital tokens. This comes in different varieties. We can talk about this in different ways. There's an opportunity for financial institutions to invest or provide investment opportunities for their clients into this space. There is a regulated path for the retail industry, and then there's the unregulated side for people of all kinds. When we're talking about digital assets, we're talking about an asset that you can use, one that's expressed in ones and zeros. That could be a cryptocurrency like Bitcoin. It could be a token that represents a company's service or product, or it could be the digital representation of a security, of a stock, of a bond. Why are people interested in this? Well, crypto, digital assets, it's very efficient. You're able to use this technology to get rid of a lot of legacy layers that charge fees, that are slow, that are prone to errors. And in theory, it's very safe because of the distributed nature of how ledgers are kept in using blockchain technology. But let's just say that we're still in this early stage, and so the infrastructure and the governance, well, it's early days. Now, when we talk about what we're investing in, it could be investing in crypto, it could be investing in securities tokens, it could be investing in some other kind of corporate token that offers a service. It could also mean using tokens to facilitate payments or as part of enterprise blockchains that could reimagine entire industries like shipping, for example. But we're going to stick today on the wealth and investment side to this issue. What we're seeing is a creation of lots of new infrastructures. You've got the unregulated crypto space. You've got an emerging crypto space built from scratch that wants to be regulated. And then you've got traditional exchanges and other financial institutions that are looking at this and saying, ooh, maybe I should get into this because I don't want to get sideswiped by something that I'm not involved in. There is money to be made here for all parties. So we have all this proliferation of things happening, but these blockchains don't necessarily mix, they don't interoperate. But all of them in their own way are driving the mainstream of digital assets. We're seeing also different patterns emerge in digital financial markets. So in a traditional marketplace, you've got all the stocks might be in one exchange. That's where you go. But in the crypto world, you might have all kinds of exchanges trading the same kinds of tokens. And yet at the same time, you've got players that are combining the traditional roles you'd find in classical finance. A brokerage might also be a custodian, might also be a clearinghouse. So we've got crazy new structures being created that are like what we're used to, but they're different. So to put this all together, I see 4 issues around adoption from a wealth management perspective into digital assets. And we're going to talk about these, and there's a logic to what I'm doing here before I introduce the people that can help you understand better what's happening right now. So first is the supply. What are the tokens that people can invest in? Right now, it's mainly just cryptocurrencies and futures on those currencies. What's the demand? Are actual institutional investors coming into this space? We hear about this a lot, but is it actually happening? The technology and the institutions is a third factor. So we've got this, I sort of alluded to this earlier, this evolving landscape of players and protocols. And finally, the big picture stuff around regulation, licensing, and the enter of classical financial institutions, Nomura, Fidelity, Standard Chartered, they're all getting into the game. And finally, there's a bigger issue, which we're not going to deal with. There's another panel later, I think tomorrow, that will touch on this, which is the issuance of central bank digital currencies. And that's a little bit out of tonight's scope. So I request that we keep the conversation really on this wealth management aspect. Joining me to help explain what's going on, we've got Henry Arslanian, who is the global crypto leader at PwC, Ursula McCormick, partner for FinTech and Emerging Technologies at King & Wood Mallesons, Douglas Gann, who's co-founder of GBCI Ventures, and Matthew Dibb, who's the Chief Operating Officer at Stack Funds. And it wasn't intentional, but we are scattered around the world tonight. I'm in Hong Kong, Ursula's in Australia, Douglas is in Cambodia, Matthew is in Singapore, and Henry, I think, takes the cake with Armenia. So we've got a big distribution geographically here tonight, which is also very fun. So Henry, I'm going to start with you. When we're talking about some of these top global trends, when we're talking about institutionalizing, getting people into this space from whichever direction, what are one or two things that you see right now that are super exciting?
First of all, yeah, James, thank you for having us. We may be distributed around the world, but we're all united with the future of finance and the future of money, which is very, very exciting. I think that you hit a couple of big topics that are going on right now. And I think it's a very exciting time right now when you look at the impact it's having on the broader asset management space. I mean, you mentioned supply, demand, the tech institutionalization, regulations. A lot of these are now coming all together. I mean, so for example, right now, when I look at the global level, right, you mentioned before regulations. For 2-3 years, the crypto industry was probably the only industry lobbying policymakers for more regulations. And now today, I'm very proud to say that according to Cambridge University, only 5% of regulators do not have somebody working on crypto. And the same thing on the policy level. I do a lot of work, my work with central banks. I remember 2-3 years ago, nobody was talking about this topic. And now because of Libra, in June 2019, Libra 2.0 that came out 2 months ago. And now obviously it's on the top of every single policymaker, central bank around the world. So at the macro level, there's a lot of activity and focus on it. The IOSCO, the FSB, the central banks, the ECB and others, it's become on top of the agenda. The second thing is for institutions as well. Of course, in the wealth management sector, your job is to offer services your clients want. Right now, what's really interesting, because of the regulatory clarity, because of the entry of institutional players, and the fact that a lot of crypto industry now is getting the comfort level that the traditional industry would get. For example, is getting SOC 1, SOC 2 reports, which is something every normal asset manager has or a private bank has, now that the large crypto players are getting as well. But I think the one thing we often forget when we talk about the industry becoming institutionalized is exactly what you pointed out, the demand side. For me, it's I find it very interesting if I put my professor hat for a second, is when I speak to my students, the level of interest there is in cryptocurrency. Every month, according to the data, the number of Bitcoin wallets was going up. I really believe COVID-19 has catalyzed the conversation, not only because people don't want to touch paper money anymore, but because obviously when we look at what's happening around the world with quantitative easing, with central banks' balance sheet ballooning, multiple times over the last couple of months. And I would argue another also big development, which is what is money? The question around money, the interest. I find it incredible that in 2020, the US IRS has to send by check over 100 million checks to people who probably needed the most, the stimulus check, the pay support checks they're getting. And I think this has really brought this whole topic on top of the agenda. So I think for any financial institution, the management, the leadership, this is a topic, you may not agree with it, you may not like it, but it's very likely your clients are potentially interested in. And I think you kind of have to look at it, which is, I think, very different than it was 12 to 18 months ago.
Thank you. Before I move on to some of the other panelists, Henry, give me a sense of those things. Where do you think there's going to be the biggest rate of change the rest of this year? What should people be
absolutely.
looking for?
I mean, the 2-3 areas that I'm following right now, from a purely academic perspective, from my next book that I'm writing and stuff like that, I'm really following what's happening in DeFi. That's not going to come mainstream. It's not going to affect financial institutions or asset management. The area that I'm following on the short term, the next 6 months, 12 months, I'm following what's happening with stable coins. We just hit another record of about $12 billion in AUM of stable coins being issued. I personally, now, when I send money back to Canada, I stop using the banks. I'm sending stable coins. The fees are 24/7. It works all the time, and there's more usage of it as well. But however, and I don't even want to talk about it, but the big topic that I think will be on the agenda of everybody in the space that I have a very big focus on is on the broader CBDC side. Two things that I'm focusing there. One is Libra. Second is what's happening in China. China, as we know, has been on top of it for 2014. It's very isolated. It's very focused on China, but the pace at which they move on will impact the policy speed of other countries, and that's going to be very, very interesting to watch, especially in a global context of what's happening in geopolitics and other issues at the macro level that we all know about, from COVID-19 to broader the financial crisis that we're going through right now.
Okay, thanks. And I'm sure we'll have a chance to get back to you on some of those points, Henry. Ursula McCormick, you're an ace lawyer with a big firm. You made a career in emerging technologies. When it comes to digital assets, maybe you can map out for us where you see the most progress in terms of the regulatory acceptance and the on-ramp for people to access things. Obviously, Hong Kong and Singapore, where we apply our trade, are probably at the forefront of some of the events happening. But perhaps in an Asia context, there's also Australia and Japan and so on. So give us a sense of where you think is right now the most exciting jurisdiction and why.
Okay, well, let me first tell you about the trajectory that we're on, where we're at, where we're going. We've gone from a real focus around navigating securities law regimes. We're now squarely in the zone of regulating virtual assets and virtual asset service providers. That is purely, driven, well, at least to a very large extent by what's going on at the transnational level. So the global standard setter on money laundering has basically laid down the framework for virtual asset services providers going forward. It really means that jurisdictions globally need to fall into line, need to regulate the sector. So we, of course, had some front runners in that regime. Japan, a very early regulator of the sector, in a very mature, market generally, banks, and securities houses really having a mature view around the sector. That was a good thing. We now see a lot more happening in that zone. Singapore with the Payment Services Act, Germany, another good example. Hong Kong, a really interesting place, not yet regulating the whole sector as a whole, meaning there's still a lot of area to play without necessarily triggering, the regulatory regime that is still administered by the Securities and Futures Regulator. So that space of growing that regime around the virtual assets, predominantly around AML and CTF controls, but expanding into general conduct controls, is something that is rapidly growing. What is especially interesting to watch is what's recently happened in the US around the OCC, recognizing that banks can themselves custody virtual assets. That is significant, and that really speaks to institutionalization, not of the sorts of crypto assets that that dominate the cap tables, but really the segment as a whole. Henry spoke about stable coins, absolutely a significant driver of development in this space, but not yet well understood or necessarily tackled by regulators generally. Stable coins fall into multiple potential buckets depending on how they're structured, making them very difficult to regulate comprehensively. So that area is specifically around the acceptance, the recognition by traditional financial regulators that these assets are no longer the scary beast of 2017 and 2016 and earlier, but really are starting to mature into an asset class that really deserves, understanding. The broader story, though, is that jurisdictions and institutions alike are really seeing the opportunity to remake money, to remake financial market infrastructure that is completely clunky. And what we're seeing now is the real collision of data and money, and the recognition that the more that we move into this space, the more we see around financial flows. China, definitely an interesting market to watch. The network there now has a number of really interesting blockchains that are participating in that network, and a significant amount of development on the CBDC side. That will definitely be one of the first to deploy, in my view, on regular payment use. But I remain bullish on Hong Kong. I think it's one of the most interesting playgrounds.
Ursula, are you getting a sense of, when it comes to regulation and licensing, are there certain best practices that are emerging, whether they're coming from market A or market B? I'm sure there's multiple things going on, but can you point to one or two things that you're saying this is turning into a best practice, and you think that this will be a standard setter for the way that financial institutions and investors and exchanges can develop further in this space?
Look, definitely. I mean, the core for anybody wanting to build an AML regime is you look at the Financial Action Task Force. Even if your institution's not even regulated yet, even if your regulator is miles away, you adopt those standards, and you're well on your way, and you're sort of future-proofing your business. There are some really interesting jurisdictions that are doing some good work in terms of defining standards that are quite technical and in-depth. Bermuda, a great example of a code of practice around the custody of virtual assets. It really goes into quite a lot of depth. But is there a single jurisdiction that is laying down, a perfect set of standards? No, I think that there's still a long way to go before we've got some sort of harmonized set. So generally speaking, what we're seeing is really pockets of brilliance, so to speak, and pockets of standards that where other regulators are borrowing from one another. And that's where the role of industry really plays a significant role. I mean, it was really obvious in the case of some of those emerging standards I mentioned that industry had played a strong hand in educating regulators, in coming to the table to suggest standards. We saw that in Hong Kong. We've seen that through the influence of bodies like fintech associations, through a SIFMA, another one that has been driving, recommendations around tokenized securities. But we really start to see those sorts of industry initiatives reflected in, industry practice.
One last one for you, Ursula. From a regulatory point of view, people have been disappointed by the lack of any jurisdiction to give the green light to a Bitcoin or crypto ETF. I guess the main reason around exchange traded funds is the concerns around perhaps a fork could occur, and which would sort of invalidate some of the ideas behind this. Do you see a regulatory path to acceptance for exchange traded products in the crypto space?
Look, absolutely. The problem with ETFs is so many dependencies, right? With crafting one that is credible, that regulators have confidence in, they're either waiting for a large jurisdiction to go first, and typically they're looking at the US, or looking at the reasons why perhaps the US is not approving one yet. They're looking at the status of regulated exchanges that are providing information sources. They're looking at the information aggregators themselves, and how issues like forks are being dealt with. I mean, to my mind, these are all navigable issues, but this space is a confidence game. We've seen that, those of us who've been in the game for several years have really seen that, the fundamentals haven't necessarily changed, but perspectives and, views on opportunities really have. So, I see that as a matter of time. We're already seeing a number of entities that are pushing for listing of ETFs on smaller markets, and I think that will end up serving as a sandbox, really, to start pushing other jurisdictions to go forward. But it's no doubt that really it requires a big jurisdiction to take the lead and to approve one, and the rest will follow.
Okay, great, thanks. Douglas, you are, I talked about supply and demand, and I think you're on the supply side of this equation. You're an entrepreneur, you're in Cambodia today, but your business is in Singapore. You're looking at tokenizing projects, some very creative things based on your discussion. Tell me a little bit about what you see happening in terms of how firms like yours and others are creating opportunities to tokenize, whether it's services, something financial, or something even a little more human. So give us a sense of, you know, where's the supply for the token world going to come from, and what's it going to look like?
So the way I see crypto has been moving, especially in the token space, we've been seeing a lot of utility tokens being sold, especially out of nothing, right? So they come with some concepts and then they start selling, and then you start seeing some models that center around security tokens. I see an opportunity where retail businesses, for example, say Starbucks as an IPO, right? Starbucks as an IPO, and probably Americans will buy it because it's going to IPO on Nasdaq or NYSE or something like that. But everyone else in the rest of the world who loves Starbucks will not be able to buy Starbucks shares unless they go through the very complicated process of registering for a Nasdaq or NYSE account through one of their brokers in their local country, through one of the banks, blah, 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 blah. So now imagine if Starbucks as a retail business, which has a super wide audience, issues a token. And you know, it's widely recognized that security tokens with dividend rights, with all kinds of rights attached to it, it is now available for everyone worldwide. So suddenly, this tokenization effort would enable Starbucks to reach out to everyone in the world versus just, you know, investors in America, for example. So that's one path that I think will happen in the next 3 to 5 years, especially when, you know, regulatory bodies start looking at tokenization of stocks and shares of their companies' rights, you know, using smart contracts and maybe more complicated blockchain systems in time to come. So I think that's one distinct path. And then the second distinct path would be what we see with Michael Jackson, Elvis Presley, you know. So you have this legendary people who now become some form of rights for some fund management company or some trust fund, you know. So that could also be tokenized in a similar manner, in a similar fashion, and that could be done even before they passed on. So celebrities, you know, could actually use that, and we have seen in the past few years certain celebrities, like for example, you have this boxer Manny Pacquiao from Philippines, right, who launched his own tokens, and you have I think one of the a few American celebrities issuing their own tokens as well. So they could start doing that and utilizing that for their own retail store, because they obviously will sell their own merchandise and their goods. And then that could slowly then evolve as they move on to form part of their rights or their trust fund. Yeah, so that's how.
Yeah. One area that I've talked to some venture capitalists and others about in this space is going back, you know, Henry mentioned he was interested in DeFi. So obviously gaming tokens and non-fungible tokens in the gaming world has been one thing, but I haven't really seen it take off. It's been around for a little while, and there's a big overlap in that Venn diagram between blockchain guys and gamers. But what are some of the barriers to getting some of these ideas off the ground, Douglas? Give us a little flavor of the challenges you face to make this stuff actually happen, as opposed to just talking about it.
I think on the healthy side of gaming, you have seen some ERC 721 tokens and contracts being developed. You have seen some in-game items being tokenized in that manner with you know, avatar skins and everything else. But I think where this will hit is actually part regulatory and part consumer adoption. So as of today, if you have a mobile app and it's a very popular game and you start accepting crypto, you'll be taken out of App Store. So that's a big problem, because App Store is always wants to be compliant, and they are afraid of touching crypto, and maybe it affects Apple Pay. I don't know, but the moment you have that, that's taken down. So the consumer adoption for such fungible token would be extremely difficult at this time, because mobile games obviously is a big thing right now as compared to computer games. So yeah.
I
right,
just
great.
point out that actually in-game assets is proving very difficult for regimes that are adopting a very broad definition of virtual assets for regulation. We're dealing with a lot of projects at the moment where, really one of the oldest forms of virtual asset, which occurred in gaming, are facing some pretty significant hurdles.
Yeah. Another question for you, Douglas, is you talk about tokenizing things, whether it's a service, like a utility token, or it's a security. How fungible are these going to be? So if I list something on the Douglas Gann digital exchange, can somebody who wants to trade it on the Matthew Dibb or the Henry exchange get access to that token? If I want to buy Apple stock, maybe I have to be a certain level of wealth to have a brokerage account to go get it. But it's open. It's in New York. It trades there, and anybody in the world can go to New York and get their Apple stock. But if I tokenize, even if it is Apple stock, if I tokenize it on an exchange in Cambodia, and I want to buy that, and I'm in Canada, can I do it?
I think what's amazing about crypto and this entire tokenization effort is that every exchange in the world can list you. So you don't have to really approach these exchanges. It's very similar to like Bitcoin and Ethereum and all the other mainstream tokens right now, right? So none of the exchanges are being approached by Bitcoin or Ethereum to list up their tokens, but any exchange can list them up. So when, for example, Apple stock gets tokenized, and they start distributing it on a chain, let's say for example on the Ethereum chain or the Omni chain, the moment they start doing that, any exchange can list them, which means anyone can buy them. Yeah. Then the only challenge there would be how you get fiat onto crypto and then purchase those tokens. But as of now, we can already see a lot of people having crypto as well as stable coins, and a lot of regimes, a lot of countries are beginning to issue their own version of stable coins, or like the US supporting multiple versions of USD.
Okay, great. Thank you. And this now we're moving into the demand side. So Matthew, Matt Dibb, I want to ask you, as folks like Douglas begin to tokenize things, we're seeing this recreation of what used to be classical financial services into new ways, new arrangements. So that example of being able to take one product and have it listed across many exchanges. You're in the business of helping wealth managers and other institutions get access to Bitcoin and over time other products. How are they reacting to this new world, these new arrangements? What are some of the conversations, good and bad, that you're having with these potential institutional investors?
Yeah, look, it's a good question, and it comes on a few levels. I think, firstly, 2017, 2016, 2017, that time of euphoria, definitely had a long imprint on the market. When we're talking about some of these larger wealth managers, they have a longer term memory, and they can remember that the complications that cryptocurrency went through in the aftermath of that whole period. So there is a little bit of, I'll say, a smudge next to the crypto name because of that. But at the same time, I think, when you look at institutions in crypto, institution is quite a vague word, because you can be talking about banks and pension funds, or are we talking about traditional hedge funds and wealth managers, et cetera, or private banks? And they're very separated right now. So on an institutional style, if I talk about banks, then they're really coming into the market from a picks and shovels point of view. Okay, they're looking at creating custody. They're looking at creating insurance for cryptocurrencies. They're doing banking for the exchanges. These are all great things, and infrastructure is being built all the time by them. But if we are looking more so at a wealth management point of view, in terms of those who are wanting exposure to actual cryptocurrency, that's where it's a little bit different. So we are seeing more significant demand amongst family offices, traditional hedge funds, high net worth investors. And, I think there's a lot of reasons for that. Obviously, the market and where it's been over the course of, the past 6 months. There's a lot in the press right now about people reevaluating the traditional 60-40 equity bonds portfolio split when bonds are paying negative. And where does Bitcoin fit in that? Is it an alternative asset? Is it its own asset? How uncorrelated is it? So people are really starting to ask those questions. And I think one of the most interesting parts about that, in talking to family offices and wealth managers, those who are in the wealth management industry may not necessarily believe in Bitcoin or even as a speculative asset or a store of value or anything. However, what we are seeing is the underlying demand from their clients. So a lot of wealth managers and family offices can no longer ignore it because the gains are there. The Bitcoin, for example, which we almost deal in exclusively, has died and lived almost 8 or 9 times now through multiple crashes, and it's still around. This week it hit the highest open interest on the CME for Bitcoin ever. We're seeing options products being made. So the market and the infrastructure is building significantly, and the demand is, particularly this year with what's going on and what we're seeing, the depreciation of the US dollar, we're starting to see that really come to fruition. So from our point of view, I think there's a lot of roadblocks still. Getting access to crypto from a traditional point of view is still hard. As Ursula said before, there is no ETF, and that has been a problem. You've got trusts like Grayscale in the US that trade at about a 30% premium to their underlying assets. You've then got exchange traded notes in European countries and secondary markets in Germany that are very low liquidity. Otherwise, you go to a prime broker or a unregulated exchange. And for us, we see that as a hazard. We see that as a problem for investors wanting to get in because it can go wrong, and it's gone wrong in so many countries. So we believe that giving the right access to these higher value clients is important in terms of compliance and insurance and custody with traditional names. And to answer your question, the demand that we're seeing now is not just in terms of price, but it's because of education. And we're seeing the likes of Paul Tudor Jones come in. And he says, well, we're now allocating 2% of our funds under management to Bitcoin. That was big. We see Fidelity come in and say, we're going to start custodying your crypto. These have all helped from an infrastructure point of view for people to have more of a belief in the whole ecosystem and investment.
When it comes to the way that people want to access these things, there's a lot of funds and there's a lot of strategies in the crypto space. But they tend to be statistical arb and type of hedge fund strategies. They are quantitative strategies, and there's some high frequency, low latency stuff in there. What we're missing though is the fundamental side. Obviously, we're talking just with currency, so it may not always be obvious what the fundamental play is. But if someone's talking about, am I going to buy dollar sterling or euro yen? There's usually a fundamental analysis behind that somewhere. Is the lack of a fundamental stock style picking opportunity in crypto a good thing, a bad thing, neutral? Does it matter to the people that you're talking to, Matt?
I'll tell you what the issue is with that. It's not that it wouldn't help the ecosystem, because managed long short funds and fundamental funds are great in every industry. They should be able to minimize risk and downside in a bear market. However, the real issue when it comes to cryptocurrency is actually liquidity. Now, if you were a fund manager that was holding in cryptocurrency, maybe more than 10 coins or so, you can't possibly scale that up to say more than $100 million, okay? Because the liquidity is so small. So all of a sudden, when you look at scaling a substantial fund, you have to pick, well, how many coins can we actually have with a very little gate to the fund where people can redeem and viably trade these products without killing the market? And realistically, the answer to that is probably about 4 or 5 coins. That's it. So the value benefit of going with a long short fund manager, a fundamental fund manager, isn't all that great. And if you look at a longer term horizon, long only non-discretionary funds that are just holding Bitcoin, generally irrelevant of fees or anything like that, will outperform most managed fund managers. And that's the same for equities as well, but it's most definitely for crypto. And to your point, when you talk about, for example, quant funds or ARB funds, most of them can only raise probably up to $20 to $30 million before their strategy breaks. So there isn't really a way for, at an institutional level, that they're able to take exposure or even distribute that type of product to their clients because it will affect liquidity. That's just the nature of where we are in the market.
Okay. I've got a question from the audience. Before I get to that, I have one last question, which I think is really for everybody on the panel. And if you're listening in and you'd like to ask something, get it in now, because we're down to below 10 minutes. My question, and I'll start with you, Matt, but I'd be interested really to get a sense of the others, is right now, when we're talking about investing in digital assets, we're still talking really about Bitcoin is, I don't know what, 70% of the liquidity, and then a few other, currencies, as opposed to, what we could call utilities or stocks or bonds written in digital format. So at what point do we get to where, if you want to invest in digital assets broadly, you have a selection of asset classes within digital, where you've got currency, equities, debt, and then let's call it tokenomic type opportunities. Matt, you want to give us a sense of what has to happen, or how long it'll take before, the people that you're trying to help facilitate into this space will have that opportunity?
Sure. I mean, I think at a high, for retail, it already exists. So for retail, you already have segments that are protocols. You have DeFi, as Henry was talking about before, which is hot right now. It's outperformed everything else in the world. You've got D-apps. This actually already exists on a retail level. The question being, and I guess the point of this panel is, when can institutional get into that? I foresee that in the coming year or two, and it's already being created, but there will be various vehicles around that will give you exposure to a basket of the top currencies, for example, or perhaps privacy coins or something like that. But that's not really going to happen on a broad and large basis without more access, without a better ETF, without somebody taking the lead. So in short, it's happening for it to get to a level in which it's not just, a micro cap segment of what already is, a market in its infancy. I think that's probably at least 4 to 5 years away.
Anybody else on the panel want to chip in on this question?
Yeah, maybe one thing to add on this, it's a very good question, right? I mean, I'm a big believer in the importance of funds in the future of the crypto industry. In the same way, if you look at the hedge fund industry, the venture capital industry, the PE industry, in the 1990s, a lot of the institutional investors got into this alternative space by allocating a bit of ticket to a hedge fund or a PE firm, listening to the quarterly or investor calls or monthly investor calls, and gradually brought that expertise in-house in the last 10 years. And I really believe we're going to see the same thing happen when it comes to funds. However, I mean, every year we publish the Global Crypto Hedge Fund Report at PwC. The industry is still very, very small. I mean, just to give an example today, the median ticket size into crypto hedge funds is $200,000. The average one is 3.1. I mean, 2/3 of crypto hedge funds have tickets of less than $500,000. And even if you look at the size of the crypto hedge funds as well, the median fund right now is 8.2 million. The average one is 44 million or so. So for institutional investors to put a ticket in there, for a lot of them, it cannot be more than 10% of the fund. And second is that minimal tickets they write. So we need kind of the industry to grow from that perspective. And also for that to happen, we need a lot of the funds to beef up not only on the investment due diligence. I absolutely agree with all the comments that were made on the strategy, the liquidity, and so on and so forth, but also on the operational due diligence, which is very, very important as well. And frankly, that's where we're seeing a lot of right now, a lot of progress. I mean, just to give an example, last year, the number of funds with independent custodian went up from 52 to 81%. And also the 86% now are using independent fund administrator. And what I find personally, the data that's the most important, now 43% of crypto hedge funds are using an independent director, which is very essential if you want to pass operational due diligence of institutional investors, which is what the industry needs for the base to grow, if you want, for capital coming into the industry.
Okay. Well, I'm going to finish up with a question we had from the audience. And I think Douglas and Ursula are best positioned to answer this one. Standardization. What role does standardization play in increasing institutional adoption? So Douglas, you want to give us a sense of where you see that? And then Ursula, you can wrap it up.
I think everything that is being built has standards and benchmarks. So I believe the standardization that we're looking at right now is we have multiple blockchain technology available, from Omni to Ethereum to Light to Ripple and everything else. And everyone seems to try to position themselves for a certain industry. So I think that by itself is really setting a standard for that to happen. So like, for example, all the crypto tokens that were being issued in the last 3-4 years, the bulk of it was issued from Ethereum. And then you have EOS and you have Ripple. Most of the banks are working with Ripple. Yeah, so I think standardization would play a big role here.
Ursula, you want to chip in on that
Yeah,
one?
look, I would agree. Most institutions, and let's talk about the big end of town. Definitely needs to see a pathway, and generally most large institutions want to see a principles-based approach adopted by regulators, but they do want some confidence that there is a way to navigate the expectations of regulators for an emerging asset class, or emerging use of technologies. As to specifics, I think that becomes less relevant, but again, it does instill confidence that there is a way through, and that there is a level of commonality and being in the pack. You hear this a lot from large banks, especially, that they want to be in the pack. They don't want to be an outlier. Some do want to be ahead of the curve. They're either there or they're pushing that envelope. The only other thing I'd add is that already there is a significant number of assets that are out there for the average retail investor. A lot of really interesting DeFi products, deposits, loans, all sorts of interesting things. The issue is, how do you make that in a safe and regulated environment? And by the time we get to that point, individuals won't even know that there's blockchain technology that's underpinning their funds, their fractionalized shares, and other types of products. So it is a long journey. For the time being, I think for the full suite of products that you mentioned, that will be a professional investor game for quite some time.
Yeah. And last question, Matt, I'll ask you, where is the greatest impetus for driving adoption coming from? Is it going to be from the big institutions coming into this game and making everybody feel like it's safe to play in? Or is it coming from the startups, the guys pushing the envelope, the technologists? Which one will be the one that really sets the tone for what's going to happen with mass adoption?
That's an interesting one. And actually, Ursula just pretty much made the point. It will be someone that brings out a retail product, if it's not already widely used, and it has blockchain and digital currencies underpinning it. I mean, Libra is probably a great example. People won't even know what Libra consists of realistically. However, if you think about gaming as one, whether it already has tokens within it for whether it be reward or redemption, whatever, integrating blockchain with that, all of a sudden you've just made millions or tens of millions of people use these tokens, and they don't even know it. They don't know the complexities that are behind it. I think that's huge. However, on an investment level, one thing I'm excited about that I think is going to drive a lot more interest to this space is Coinbase's IPO next year. I think that will be a big one for awareness in the US. I think it will kick off a whole nother round of speculation and adoption within the industry. And they're marking that at probably 15 to 20 billion by our metrics. So it should be pretty significant.
Okay, well, great. So that's a great note to end this dialogue on. Gives us something nice and specific to hang our hat on. And when Mushir and his crew bring us all back together again next year, I don't know if this will be a virtual fintech fair or a different kind of fintech fair, but at least we'll have, I think that'll be the starting point. That'll be the starting point, what happened with the Coinbase IPO and what are we going to see in Asia, right? I mean, this is also a dynamic area. We may not have the same heft of the US regulators and the size of that market, but there's a lot of innovation happening here too, across the region from India to Japan to Australia and all points in between. So with that, I'd like to thank my panelists, Ursula McCormick, Douglas Gann, Henry Arslanian, Matthew Dibb, and I'd like to thank the audience for showing up, because obviously this was the best panel of the entire fair. So you don't even have to tell us, but thank you for your time, and hand it back to our friends at the Virtual FinTech Fair.